3, 2, 1. Welcome to the show.
Welcome to the show. The barely pre-Christmas show.
Yeah, man, it's almost. You got your Christmas shopping done?
I'm pretty close.
I got it all done. I'm going to start wrapping today, and I'll probably finish wrapping the night before.
Nice. Yeah, that's always the way it is.
It never fails, man. Yep. Even though I get all the shopping done, I'm not going to get all the stuff wrapped. Man, we're looking kind of yellow today.
Yeah.
Trust me, folks, I work really hard on trying to figure out what the heck these cameras do.
They are a bit. Yeah.
Yes, these weird lights in here, but get past that, listen to our youthful voices.
That's right. That's right.
What do you got for us this week?
All right. It's been a crazy week. Roller coaster ride, to say the least. So we're going to take a look at a few different things. We're going to do a little review of the dead cat bounce. I think we talked about that 2 weeks ago. Some thoughts about taking control of your TSP. We're going to look at one of the methodologies that can have you take control is the Investor's Business Daily methodology, and how how they use a mutual fund theory or methodology to decide when you should be buying stocks or when you should not be buying stocks. And then we got one chart that combines both Elliott wave count and overlays the Andrews pitchfork. Talked about Andrews pitchfork a couple of weeks ago, and it gives a pretty good graphic of where we are in the long term. Bonus chart is going to be Rivian. We did Rivian earlier in November, and it's been quite a ride. You think TSP has been volatile? That is nothing compared to most of the if you're an IT, if you're a tech company, but you're not one of the FANG companies, Facebook, Amazon, Netflix, Google, if you're one of the tech companies but below that level, Rivian is a good example. And then we'll look at the 2-year weekly charts. Okay. So we put up this graphic 2 weeks ago on the December 5th show. So the phrase dead cat bounce, we talked about on the show, kind of gave the definition of it. It's been around Wall Street for a very long time. So this particular one was from a guidepost back in 2008, because as most of us probably recall, 2008, the market was falling off the cliff, right? And the big question was, how far does it come down? And then what kind of a recovery do we get? And is it a V bottom, or does it fall and do a dead cat bounce and maybe some kind of a double bottom? Or, does it do some kind of a triple bottom? Like, do we get some kind of stability here, right? So what do you suppose this would look like currently in real life? So you get a visual of what that looks like right there, right? Does it look like that?
Kinda does.
Kinda does, right? This is the last 6 weeks of the S fund, where each tick is 2 hours. So this is what a real life dead cat bounce looks like. We had a top back here. We roll over, do this dead cat bounce. On December 5th, which was this is the bottom. The 6th is the beginning of the next day. So December 5th, when we did the show, that was the Sunday, because the 6th is the Monday. So when we did the show, we put up that dead cat bounce slide. We were at the bottom. Didn't know it yet, but that's where we were. The cat was splatting.
Splatting all over the ground.
Cat was splatting. Now, he does a little recovery, right? And people had been asking kind of back in here, like talking about the dead cat bounce, right? This gap up, and then within a day or two, it rolls right back over. That's the dead cat bounce. That's what people think about, because we came out of the trading range, right? So the bounce took us out of the trading range and then rolled right over. All right, so we rolled over, and this blue line is Friday. Okay, so this is where we are right now. So there's a couple of possibilities here, right?
At some point, does the cat stop bouncing?
Yes. The answer is yes.
Because, it's dead. It's got to stop bouncing at some point.
Well, so the question is, right, in the the picture, the ground is here, right? So in the picture, the cat just dribbles off like that, right?
Yeah.
Okay. So in real life, do we get kind of a bounce and back down and a bounce and back down? And are we getting some kind of consolidation here to move lower, right? So that's kind of where we are right now. We get this potential support line here at 2100, right? So if we get some kind of continued consolidation with the descending triangle pattern, that implies the next move is down.
Mm-hmm.
That's one possibility. The other possibility is we get some kind of a double bottom pattern here, right? And it moves higher. Maybe we get some kind of a triple bottom pattern, right? So we got a 1, a 2, a 3, and it moves higher, right? Which is another flat pattern. You don't know. So
yeah, we don't have enough yet to give us a higher probability either way right now, right?
yeah, you don't know what's going to happen going forward. So all you can do, like, let's say you look at this and you say, okay, 2100, we had a low at 2100 here, we had a low here and a retest. 2100 is a pretty important level. Perhaps you would use 2100 as your line in the sand. You could.
Meaning it goes below that amount.
Yeah, that's a possibility. That's
right.
a choice you can make. Yeah, that's one possibility. Okay. That's sort of the idea of a dead cat bounce. So if you don't have a plan, you can't really use that chart. If you don't have a plan and be able to identify the different possibilities of that 2100 line, for example, clearly there's support there, right? That should be a level that if it stays above, you can, expect the market to continue higher.
Mm-hmm.
If it goes below it, now that line becomes a resistance, and now it's a different kind of problem. So
Either way, you got to have a plan.
Either way, you don't have to have a plan, but if you don't have a plan, you're banging your head against the wall every time the market goes up and down.
Yeah.
I mean, you can do what you want, and that's sort of the point of this, right? Do you have a plan? There's basically two ways to play the TSP game, right? Are we on the slide, or are we talking? Okay.
We're talking.
All right.
Now we're there.
Now we're there. Okay. Do you have a plan, right? There's really only two ways to do it. You can create a plan, work the plan, make adjustments to the plan, and keep on moving, right? Or you can take what the market gives you. If you have a foot in both camps, the market will crush you. I mean, really, you're crushing yourself because you don't have a plan. But here's the thing. You can take some kind of analytical approach, whether it's technical analysis, fundamental analysis, seasonality, whatever. But it's the basis of your plan, right? Within that, you got to understand multiple time frames, because we just showed a 6-week chart where each tick was whatever, 10 or 15 minutes. It looks much different than a weekly chart or a daily chart of the S fund, right? You got to have your lines in the sand. That's the whole point of how you would use the plan that you have. We talked about 2100 line, for example, and why that would be a reasonable line in the sand. And that enables you to quantify your risk, right? Whether or not that fits your personal risk tolerance is a different thing, but it allows you to quantify your risk. So all this is in having a plan. It takes away all of this. I mean, we're all human, right? I hope the market goes higher. I hope it stops going lower, right? What? Hope it's not a plan. I hope the market keeps going higher. Absolutely. That's the only way we make money in TSP is if the market goes higher. But if these quotes take over your brain and don't enable you to have a plan and work it this way, I hope the market goes higher, stops going lower. I get a good feeling about this. I get a bad feeling about this. I just can't take it anymore. I'm just going to stop. I'll stop watching and it'll come back. And when it comes back, then I'll start watching it again. Like, those are all emotional responses to a system that requires an analytical observation. So you can do whatever you want. And, I hope the market goes higher too, but I'm prepared whether it goes higher or not. That's the point.
Yep.
So, okay. So here's an example of a system. If you don't want to create your own, here's an example of a system that Investors Business Daily gives us, right? Investors Business Daily newspaper, one of the leading financial papers in the world, gives us an example, a methodology that can absolutely be applied to managing TSP accounts, right? So we're going to take a look at the methodology, how it plays out in real life, and then their results over time. Okay. All right. So this is a little bit old. So forget about this, changed on July 16th. It's not important. This is their actual methodology. So
yeah, we don't want to share their current one because we don't want them to sue us.
Yeah, well, I hope they don't sue us because on the next chart I am going to share their current one.
Oh,
That's okay.
Oops. Well, just so everyone knows, we have no connection to them, and we're only giving, hopefully some of you will actually go use their products because we like them. So
IBD
don't sue us, IBD.
Yeah, no, please don't. If anything, we're giving you more business, and we're giving you we're putting the link in right there. Okay. So how does it work? They have a column called IBD's Market Pulse, right? And how it works for them, we generally use the S&P 500, our C fund, as like the baseline. They're using the NASDAQ. Okay, the QQQ is the ETF for the exchange traded fund for the NASDAQ Composite Index, which is big tech. Okay. So they have a algorithm that determines whether the market is in a confirmed uptrend, market under pressure, or market in correction. Okay. So when the market is in confirmed uptrend, they're saying that in this methodology, you would be 100% invested in the NASDAQ because that's their baseline, it's the NASDAQ. When their algorithm says market's under pressure, you would be 50% cash, which for us is the G fund. So for them, it's 50% cash, 50% NASDAQ. If the market's in correction, you are completely in cash. Okay? Very simple. On their algorithm, if the market's in a confirmed uptrend, you're 100% invested in the NASDAQ. If the market's under pressure, 50% in the NASDAQ, 50% cash. Market in correction, 0 in the NASDAQ, 100% cash.
And if you haven't watched this show enough, I mean, just the little bit of analysis that we do to tell you where CS and INF are going, you could use that strategy all day long.
Yep.
I mean, without question.
Yep.
And make your life very simple. Now, you're not going to make ridiculous gains.
Nope.
But what you're doing is you're taking out the guesswork. Right? That is a strategy. That is a plan, what Jerry just showed you. And it's a very, very conservative plan, but literally thousands, if not tens of thousands of people use that to make money, right? Make good money and and sleep well at night.
Yep,
right?
Definitely.
So that's, because I can just see the naysayers right now, right? They're just like, oh, that's not this, that's not that. We know that the point is, first of all, if Investors Business Daily, has come up with this, it has been tested and tested and retested.
Yeah.
They constantly back test and retest.
And it's not perfect.
No, but it's also meant to be simple.
Yep.
That's the whole point.
Yep.
And you can literally track, all of your accounts that way.
Yeah.
And you will come out far better than, wishing and hoping and.
Yeah, I mean, it's not. To me, it's not so much that you'll come out better. It's that
it takes
I have
emotion
some
out.
control. It takes emotion out, which matters because now I've already made the decision, right? And so if the market goes below my line in the sand, I've already made the decision. I'm out.
Mm-hmm.
I mean, I'm not happy because I'm going to lock in those losses, right? "Quote unquote," lock in those losses. Yeah. I'm not happy about that.
But it is what it is.
But that's it. And then when it turns back around, I have another line in the sand that tells me when to get back in, and I get back in. And I go to my kid's concert or whatever, and I'm not worried about it. I don't care.
Right. Yeah.
You know what I mean? It's not that I don't care. It's
Yeah.
that it's not going to wreck my life. I'm not agonizing over whether or not I should do this or that.
The best fund managers don't obsess over the market.
No, you can't. You can. I mean, guys, jumped off of buildings in 2008, but it's because they didn't have a plan that either they believed in.
Right.
And I hate the word believe, but to me, it's very simple. You draw your lines. You draw your lines for a reason.
A plan that you trust.
Yeah.
A plan that you're confident in.
Yeah.
I mean, at some point, we're all humans. We have to make a decision. There's going to be a slight bit of emotion. Let's just keep it as the least amount of emotion as possible.
Sure. It can be applies to everything. If you buy a house today, right, you hope that your house is going to go up in value over time.
You do.
And most of the time it does.
Yeah.
Sometimes it doesn't.
Yeah.
Right? But you can only respond to the market at the time. Or you can say, I love this house. I don't care about anything else.
Right.
This house makes me really happy.
Right.
And I'm going to buy it for an emotional reason. There's nothing wrong with that.
Absolutely not. But you just got to know why you're doing it.
Yeah.
That's it.
Okay. What does it look like in real life? So this is the part where IBD hopefully won't sue me. I don't buy Investors Business Daily newspaper anymore. I've moved up to not their highest level, but their next to highest level of products. And it's called the IBD Leaderboard. And this is a picture of all of their changes, and actually more than the changes. The blue is where the blues are where the changes actually came out. The reds are like updates, right? Kind of like our market updates. All right, so let's just go back a little bit. We don't have to look at all this. This goes all the way back to June of this year, but we don't have to look at all of them. Let's just look at a couple. So back here when we first kicked off the last rally in October, okay, market had a bottom here at the end of September, October, got above the 10-day moving average line, came down, and then gapped up, had support, gapped up, and IBD said, okay, we're back in a confirmed uptrend. Okay, so confirmed uptrend means we're back in 100%. For them, it was in the NASDAQ composite, so that the QQQ. You'd be 100% invested in the QQQ on that day right there. Okay. They noticed that the market is stalling up here. Right? Market's stalling a little bit there. So they're telling you that. Then we had a distribution day here, which means high volume selling. Okay, distribution day. We had another distribution day here, high volume selling. Okay. The day after this distribution day, we went to market under pressure. Okay, which was right there. Market under pressure means you're 50% invested in the QQQ, 50% in cash. Market continues down, and we went to market in correction right there. It was this big volume down day right there at the end of November. And it happened to be the bottom of this correction. So at the bottom of this correction, IBD moved to 100% cash. So what does that mean? It means they went to market in correction, so their exposure is zero. So they went to 100% cash. The market rallied the next couple.
Which for us would be the G fund.
For us, the G fund, right?
Yeah.
So the market rallies the next couple days, and they're still 100% cash. This was a pretty big percentage move, right? But their algorithm said, nope, we're still in correction. This was the dead cat bounce. Market rolls over. Gives us a little bit of a double bottom here, and then had a huge breakout. A couple days ago, it was this week. It was, I don't know, Monday or Tuesday of this week. Huge breakout, and we go back to confirmed uptrend. Now we're back 100% in the NASDAQ. The very next day, the market rolls over. So let's say this is Friday, Thursday, Wednesday. So on Wednesday of this week, they went to confirmed uptrend 100% in the NASDAQ. The very next day, the market rolled over on the Thursday. And then on the Friday, it doesn't show it on this, but their updated allocation, they went to market under pressure. So as of the close on Friday of this week, they moved to market under pressure. So 50% cash, 50% NASDAQ. Okay. So not unlike what we've done over the last couple of months, if you go back and look at this, they've locked in, quote unquote, locked in their losses. They didn't get any of these gains. They went to confirmed uptrend right here, and then the market immediately turned over. There's a lot of churning. No one has a crystal ball, not even IBD, obviously. They're doing the same kinds of things that we're doing. I don't follow the IBD market strategy methodology, right? I use it to validate my decisions, but I definitely don't use it as a basis for my decisions. So again, as of the close on Friday, it's market under pressure. Okay. So we look at all this and we're like, all right, there's a whole lot of stuff going on in here, and we locked in losses, we got a little bit of gains, and I don't like this because all I see is I keep locking in losses. Here's what, over time, the methodology looks like, okay? So we go back here to 06. Again, the IBD methodology is based on the NASDAQ, okay? So the yellow line here is the S&P 500. It's not really valuable for the conversation because they don't use the S&P 500, they use the NASDAQ. So forget about the S&P 500. The green line here is the actual NASDAQ. The blue line is the IBD methodology. So did they beat the NASDAQ? No. But they're not trying to beat the NASDAQ. The blue line is the IBD methodology. So you remember back here in 08, right? When the market, the NASDAQ, kept tanking, the IBD methodology leveled off because at some point they went to market in correction and they stopped investing in the NASDAQ, and the NASDAQ kept going lower. So for years, until 2014, the methodology had been outperforming the NASDAQ in general. Okay. Then in 18, we have another, or before 18, 15, 16, another correction, and the methodology didn't do as well as the NASDAQ did. And so now the NASDAQ is pulling ahead of the methodology. And you can see in there how the methodology flattens, the market tanks, the methodology doesn't go down as low, but you also don't get those last bits of highs. So it's a managing risk methodology. At the end of the day, you're managing the downside risk and you're getting the majority of the gains. Okay, so it's just an example. It's similar to what we do.
Yeah, and the 334% versus 428% also leaves out the whole concept of their dollar value, the amount of money they had in their pot didn't take those big drops, right? So when the NASDAQ took a while to get back there, they were still kind of hovering at that previous spot, right? So it all kind of, I wouldn't say washes out in the end, but the idea is it's way more stable.
Yeah.
Right? It's way more predictable than wringing your hands in emotion and going, oh my God, what's it going to do? They're not at all.
Yeah.
They're sleeping well at night. And they're really only making two moves, 100% or 50%, well, 0%.
Yeah.
They're either all in, half in,
or
all out.
Yeah. And that's only the NASDAQ.
Yeah.
Right. So ours is a little bit more complicated. You have three funds, and if you want to drill in and say, well, which of our three stock funds should I be in versus the others? Or you can make it really simple and say, hey,
spread them across.
That's what we do, right? Generally, spread them across. Or you can say, you know what, I'm just going to do the C fund and follow this methodology exactly.
Yeah, sure, for sure.
You could do that, right? Yeah. Simple
yeah,
way to do it.
You got more opportunity for gains if you include all three, but it's more work.
Yeah.
Yeah.
Yep. Okay, so hopefully that is a good illustration of a very well-established methodology that's kind of similar to ours, and how it plays out over the long term. Okay, so back to kind of reality. Where are we, and what are we thinking about going forward? So the next chart here is the 18-month daily chart of the C fund. And what I did, I put the Elliott wave count in here. So if you remember back into the COVID low in March, we had a 1, 2, 3, 4, 5 to this point right here, which we're calling the 1 on the Elliott wave count. We could say this is the 2 or this ABC is the 2. It doesn't really matter which way how you want to look at it, but for the purposes of this chart, I'm going to call this the 2. We've had this extended move for a year. At some point, that extended move is going to end. And when it ends, it'll be the top of the 3. Did it end in November? Was November the high for the 3? We don't know yet. Because if we're looking at this chart, again, it's the C fund, right? So forget about all the chaos that's going on in the S fund. But in terms of the C fund, we got this median line, and we generally find support at it, right? Right now, we're basically at support at that median line. So there really isn't anything to do if you're a long-term follower of the C fund. The trend is still up, and there's no indication really that the 3 is in place. If we look at the best sort of similar pattern setup was kind of back here, right? We had this high. We got this high here in May, and then we kind of went flat until the middle of June. Kind of similar to here, we hit a high at the beginning of November, and we've gone basically flat ever since. So if you're making decisions based on this chart, you're not really worried about it, because every time it hits that median line, it does something and it keeps moving higher, right? And if it moves higher and closes up here somewhere, then this 3 is not in place yet. If, on the other hand, let's say the 3 is in place, we're going to get some kind of move that will bring us down to find support at that lower channel line. And whenever that happens, that will be the 4, right? You got a swing high, a swing low at the 2 that generates this Andrews pitchfork. And the idea is that you have the 1 at the swing high, the ABC at the 2 is at the lower channel line. The 3 should hit the upper channel line. The 4 should hit the lower channel line. The 5 should hit the upper channel line. That's the theory of how it works. So where we are right now, there's no way to tell whether or not this 3 is in place. If we get below the median line, okay, we've done that plenty of times. Got below the median line and kept moving higher. This is just one tool. I mean, if we get below 4,500, we can draw this line. There should be support here. We're a little bit below it there, but when we came and made new highs. I think 4,500 is a pretty important level. If we close below 4,500, I expect us to hit this lower channel line. Even if we hit the lower channel line, I'm expecting 1, 2, 3, 4, 5, up to the 5. So I'm not too worried about where we are. In the short term, yeah, there's a pretty big percentage move in here, and people are freaked out about the short term, but I'm really not too worried about it. If we closed below the lower channel line, now clearly the whole thing is different, right? If we close, when we close below this channel line, the whole thing is different. When that happens, let's say it does, and we get down here and we close below that channel line. And now do we have support at this low and this low? Right? Can we keep going sideways? Can it do a different pattern? Yes. All those things are possible. But until it gets out of that channel, the market, the trend is up. So until the trend is up, until it's not up, it's up. So that's where we are in the C fund. At least the big picture. That's where our broad trend is in terms of TSP. Okay, Rivian. I can't remember who was asking about Rivian back in November, but it IPO'd. I don't know, like around the 10th, I think, of November. And we got a request to look at it as the bonus chart. And so this is what it looked like on the day that we did the bonus chart the last time. So, yeah, it was the 10th of November. IPO's right here. Came up, came down. So this is a 3-day, 5-minute chart. So each tick is 5 minutes. So on the first day, it opens right here, spikes up, comes down, consolidates, gaps up the next day, keeps on moving, and then consolidates. Does this really nice, flat, kind of curved consolidation, and that's where we were. And do we want to buy it? You know, clearly it's not the time to sell it because we had it got support at the bottom of the this consolidation. I mean, I would say it was a great time to buy it at the time. Again, this is a 3-day, 5-minute chart. And this was on November 10th. So if we fast forward to today, this was November 10th. This is that curved consolidation that we looked at, right? We had the big run up for a couple days. It opened, came down, came up, that consolidation, and then it went ripping higher. So this was $130 here, and it went up to $180. That was a huge move in a couple of days, right? A couple of days it took for that to happen. Hit a high of about $180 a share. If we had drawn this trend line on that day that it wasn't even the day, it was this is a 15-minute chart. So in the period of 15 minutes, it broke that trend line, and it was all over from there. So in the past month, roughly, because this is a 6-week chart, IPO day right there, past 6 weeks, comes down, consolidates, comes down again, puts in a low, dead cat bounce, let's call it that, back up to the prior high, comes down, can't get above it, comes down, can't get above it, keeps coming down, gap down 10% on Friday. And this is where we are right now as of the close on Friday. And it is at 97.70. It's $2.70 above its all-time low, which it put in on the first day. So a lot of people excited about Rivian. They had a huge contract with Amazon to provide electric tractors for all the Amazon warehouses and stuff. Not something I would be buying right now. But it's just a good example, whether or not it happens on 15-minute increments or you're looking at a weekly chart, a daily chart, whatever, you just draw the trend lines. And when the trend lines break, it doesn't mean you're going to get a complete sell-off like this, but it definitely means that the trend has changed. If you're down here and you're like, it'll come back, no problem, it'll come back. I mean, this isn't a logarithmic scale; it's a price scale, so it's linear. So you can't really see the actual value in terms of on a percentage basis. But from, if you saw this consolidation here and you're like, it'll come back, no problem, and then it gaps down again, comes down, comes back up to where you thought, you're like, oh, it's coming back, came back down again. I mean, the market crushes you if you don't have lines in the sand. It does. Okay. All right. TSP funds. These are the 2-year weekly charts of the TSP funds. So, like we said on this is the C fund. Like we said on the Elliott wave count and Andrew's pitchfork chart, the trend is up. There's nothing here that would indicate that the trend is moving in any direction other than up. But there is a couple things to look at. That's why we have technical indicators and we have volume and other things. So first thing is this. In the last 3 weeks, we have 2 weeks of really high volume down weeks, right? And we have the 1 week that we got support at the 10-week moving average line, and we came roaring back up to new all-time highs, only to come down again this week. But last week, when we roared back up to new all-time highs, we did it on relatively low volume, right? Because you got that sort of sandwich of the low volume day in between, or low volume week in between the two negative high volume weeks. It's not bullish, right? Doesn't mean that the trend has changed yet, but it's definitely worth looking at. And then in terms of the MACD and the RSI, we put in a high here on the RSI back in end of August, beginning of September on this high, right? On this high right here. Price continued higher, but even as price was continuing higher, the MACD was trending down. So we had a divergence, right? Price is going up, MACD is coming down. RSI didn't come down. It was basically the same at this high as that high. But now the RSI is dropping off. So is price going to follow, right? Are the technical indicators telling us that price is going to follow? It doesn't have to, but it's definitely worth looking at. So if you've been looking at this and going, I've had enough, I can't take it anymore, and based on the technical indicators rolling over, I'm going to go to G fund for a while because I think whatever I think, or I feel whatever I feel, that's a reasonable thing. Reasonable because you got 2 really solid high volume down weeks, with the recovery week on low volume. So can the market roll over from here? Absolutely. But it hasn't rolled over yet. S fund is a much different story. The moving average lines haven't really been very helpful as support and resistance levels for the S fund. So let's just take a look at this trend line that I drew right there, right? If you connect basically the bottoms going back to February, you get support at this trend line, right? We get support all the way along that trend line. We broke that support within the last couple of weeks. Broke down pretty hard through it a couple of weeks ago, 2 weeks ago. Last week, we rallied, got above that support line within the week, but then closed below it again, right? And then this past week, we came off again. The MACD has been declining ever since the high in February. So the big question really is this pattern going to continue down? Is this a topping pattern, or is it like a stealth correction that's already happened? So can the MACD turn back around from here? Because it's already come down so far for so long. Can it turn back around here? Yeah, it's possible. Can it continue down? That's possible too. There's no reason why you wouldn't look at this chart and say, I don't want to be in the S fund, because what had been a support line is more likely than not going to be a resistance line going forward. So would absolutely be a reasonable thing to do to be out of the S fund right now. I'm not saying you should. I'm saying it's not unreasonable to do that based on analysis of this chart. Okay. I fund, similar but kind of different. You got a support line here. We got support, 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 support. And we have this rounding top pattern. If we get below 75 on a weekly close, then this line becomes resistance to the upside. So again, it's an important support level. Just like the S fund, the MACD has been trending lower, and so has the RSI since we got a top here back in May. So the I fund has been holding up a little bit better than the S fund in the past few weeks. If it can continue higher and this maintains its level of support for price, and we get, an upper channel line, that'll be great. Maybe we do like this for a while, who knows? Maybe we keep on going higher from here, that's a possibility. But the other possibility is that we break this support level and keep on going lower. So for me, that 75 support level is pretty important. We've had a bunch of questions about the F fund on Facebook this week, mostly because people are concerned about stocks going forward and they think that bonds are going to be the place to be. And I don't have an opinion yet because the questions are based in fundamental analysis, and I have opinions. I follow that stuff, but in terms of the technical analysis of it, until it gets above that downtrending trend line, I wouldn't reallocate based on what I think is going to happen with interest rates.
Right. That's not I mean, it's definitely something to take into consideration.
Yeah.
As we're watching the technicals.
Yeah. So go back to that chart 1 second. So basically, this is a pretty long-term downtrend line, right? We had a top here, couldn't get back above it here, couldn't get back above it at any of these attempts, right? So now on the positive side, we get a pretty good bottoming pattern right there, and it's well above, the most recent low. So if we can get up here somewhere, right? If we can get up here somewhere above this prior high and above this downtrending trend line, now we have some reason to believe that price can continue to go higher. Until that happens, I'm not interested in the F fund. And the other part of the F fund, of course, is you're weighing the value of the F fund versus the stability of the G fund, right? We know that there's no risk of principal loss in the G fund. The F fund obviously does have risk of principal loss. So you've already made the determination that you're not going to be in the stock funds. And now you're deciding whether or not you want to be in the F or the G or some combination of both. Now your risk-reward analysis is the F trending higher in such a way that it's overtaking the risk of the stability of the G fund, if that makes sense.
Yeah.
So.
Does to me.
Yeah.
Makes sense.
All right.
Questions?
That's all I got.
That's a lot, man.
Yeah, I know. And then we get the newsletter that's coming out. The newsletter is going to have some of the similar kind of stuff in here, but a little bit different, a little bit more in depth. And
always more in depth. I mean,
the
weekly newsletter that goes out to our members has a lot more deep dive analysis, more lines in the sand kind of thing. And Jerry's always has his lines in the sand, and is happy to share those with our members so they can make their own decisions and validate their decisions. The system has worked pretty well for us for a long time. And when I say the system of like educating people to kind of do this on their own.
Yeah.
If you're new to our show and or not new and maybe have missed it, like that's our purpose here. Really, we're not financial advisors in this capacity. What we're here to do is educate people so that they can make their own investment decisions with their retirement accounts. Yep. Because we know out of the 6 million people that have TSP accounts, there's like this many that actually actively manage, that actually understand that they can even take an active approach. Yeah. They don't even know, right? They're too busy working. Yep. I mean, it's not a lack of desire. I think we don't get encouraged to think about this stuff when we come into the government or the military. I know I didn't.
No. Well, I mean, if you go to the TSP website, it pretty much forces you into the L funds.
Yeah, I mean, because that's what they want you to go. And I think if you're a passive investor and you don't want to think about this, don't want to know anything, then the L funds are an option.
Yeah, sure, an option. Yeah.
We don't think it's the best option. We think the best option is to manage it yourself. But if you're not willing to do that, have a plan. Hope is not a plan.
No. I hope the market goes up. The only time we make money in TSP is when the market goes up.
Sure. We all want it to go up.
Yep.
All right, guys, if you have any questions, hit us up on the comment sections wherever you find this. You can also shoot us an email at and we will info@growmytsp.com. I guess I should finish that. And we'll get back to you at some point, hopefully. Please don't ask us for personal advice. We don't do that.
No.
But if you want to chat about technical analysis or fundamental anything,
happy to do it.
And if you like it, share it with your friends. If you don't like it, share it with your friends.
Yeah. Have a great Christmas.
Yeah.
We'll see you on the 26th is the next show, right?
So great holidays. We'll be right after Christmas. We'll be doing another one. And then we got a special surprise for the weekend of New Year's. We will not be doing a quote-unquote show like this. We actually did our first interview. Yep. And, it's going to be with Scott Zane. From he's got a couple large TSP related Facebook groups on Facebook, and Scott and Jerry have been talking back and forth for I don't know
quite a while.
Yeah, more than a couple of years, I guess. Yep. And we finally were able to get him set down and have an interview, and it was actually a really good one. So hopefully you guys will be looking forward to it. We'll be talking about it more as we lead up to it. Hopefully I'm going to take a couple of clips out and do some teasers. Yep. But anyway, it'd be fun to watch, and it gives us a weekend off.
Yep, absolutely.
All right. See you guys. Have a great week.
Cheers.
Cheers.